please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me are Anuj and Sonia. Well, you can't really smile if you're a bull and you have long positions in the market. Yesterday, the Indian markets ended at the lowest point for the second straight day almost. And now it's, importantly for the Nifty, it's pierced through that 200-day moving average, which we were all hoping will provide some bit of support to the bulls. And all 2018 gains erased 10% off its all-time highs, and the mid-caps are off 14% of their recent highs. That index also ended very close to the lowest point, losing 1.5%, and a terrible breath, 6 down for 1 in the green. And today the global markets are not providing much relief. Maybe we can take some solace that we presaged that fall. Nevertheless, falling through important support levels is not a very happy portent for the bulls.
Absolutely, and once it pierced through the 200-day moving average, I think then, you know, a lot of stocks in the broader market started to correct some more. So the selling pressure accelerated after that level went. Even in the US markets, I mean, 340 points gone on the Dow. So, you know, technology stocks have sold off a lot.
No apparent reason.
Yeah. We, of course, have the FOMC meeting. So tomorrow we'll get to know whether the Fed raises rates again or not. That is the key expectation. But let's see how that plays out. For now, there's red across all screens. Anuj, morning. We were discussing this yesterday at lunch as to how, you know, once this 200-day moving average breaks, then there could be accelerated selling pressure. That came through. But do you think there's a lot more to go?
Morning, Sonia. I just want to explain a bit technical here. Let's start with a 6-month Nifty chart. You know, if you were to put a person here, right? I mean, what you would see is you know what you call the head and shoulder, right? There's a head and there are the two shoulders, and then there's this neckline, right? I mean, there's my head and there are two shoulders and then the neckline. So you're almost breaking that right now. There's been a classical copybook stuff. The market went to 200-day moving average, had a sharp 300-point bounce, which normally happens. Then the market tried to see if there's double bottom at the 200-day moving average, and there's a good chance that that test has failed. It will still require some evidence, but the market is in control of the bears. And what happened yesterday was that even a 30-40 point bounce was being sold into. There were 2 bounces yesterday as well, about 20-30 points they were sold into. So what I would want to say is there going to be a break of 10,000? Because if that is the case, then a move towards 9,700 is distinct possibility. So as I said, you know, the fact when you start to see even minor bounces like 30-40 pounds, when you start to see even minor bounces like 30-40 point bounces being sold into, that is an indication that the market has a bit of a problem. The bigger problem is in the mid caps, because they outperformed when that sort of bounce happened, because the assumption was that the market has made a bottom at 200-day moving average, so you can move on with your mid caps, and that is where I think there would be a larger problem if you break 10,000. The F&O data is very bearish for second day running. FI sold 33,700 calls. There was a call writing, and they bought 35,700 puts. So that is very negative. But the only point here is that we have had 2 back-to-back trend days, and there's a possibility that because everyone is now short, or the consensus is that now only a short trade is going to work, the market may just decide to shake out some of the weak bears, but that's not going to change the overall texture. The overall texture is that this is a market which now wants to complete a correction, perhaps a 15% correction. It's not getting done with 10% correction. Now we've seen 10% correction, perhaps a 15% correction, a move towards 9,700 just to remove the excesses is a distinct possibility now.
So, you know, just one bit in terms of, you know, this possibility of bounce. The dollar has actually gotten a little cheaper globally. That usually is the first sign of a bit of support coming back for risk assets. It's moved below 90. It was 90.3 yesterday. Today it is 89 point some decimal. And therefore that, no, I'm referring to the dollar index, say 89.87. And because of that, we have now seen crude prices breaking into the green. That could be the first of the risk assets which is getting some support. Sorry.
No, you know, the question that we get asked a lot on social media platforms is that this is still just a 10% correction, right? So it is the definition of a bull market correction. Is that still what it is?
Or yes, I mean, obviously it's a bull market correction, Sonia. But look, it's very tough, right? Because one of the bull market corrections at some point is start of a bear market.
Yes,
but you know, you won't know that.
When.
You won't know when, and that's the answer that you will know with hindsight. But given the context and the fact that this is a global bull market, unless the global bull is turning into a bear, it's very unlikely that you have an Indian bear market. That's not going to happen. And in fact, all the noise about politics and all, I think the markets sometimes get it wrong, and that's when you have an opportunity to buy. If the market's belief is that 2019 is now completely gone out of picture and all, and if that's the reason the market is falling, that might present actually the best buying opportunity.
And
that's
by
what
the way,
history has told us.
10,094 was what we last saw on December 6th. I mean, it's only 3 months. It's not as if it's wiped out. If you are an SIP investor or even a mid-cap buyer all through 2017, you're still seriously in the money.
7,900 was December 2016. 7,900, the market started rallying from 7,900. Let's just for a moment forget that we went to 11,000. Okay, from the end of 2016, in a 1 year and 3 months, this market has still given from 8,000 to 10,000. At index level, 25%. At mid-cap level, maybe 30-40%. So this is the rally has been so roaring that correction looks a bit large, but put it in context.
And that said, Anuj, yesterday there were at least a couple of fairly big brokers who were saying that they are pretty worried about the mid-caps. I asked them, is it LTCG? And they said, we can't even, I mean, that word is not even anywhere in anyone's memory. It is just that there are a lot of HNIs and traders with mid-cap positions and they are not getting an exit. So there is a desperation for those who want to offload positions, probably not fully paid for, probably leveraged positions. So the way, the desperation with which those two traders spoke to me, there is pain in those who have bought in the near term on leverage.
And just one final point. Look, there's a space called futures and options, and it's time even retail starts to use that for the reason it is there, to hedge your portfolio at times, to perhaps, and sometimes when the market is giving you a clear indication that it's going to be a tradable correction, you may have your portfolio positions, but you can still short as well and make money. So that point is also there. So there's no harm in selling a stock. Let's put it that way. Even if you love a stock, there's no harm in selling it.
Yeah, it's just that, if F&O is a difficult game, and I'm not very sure people have a 9-to-5 job, or these days actually a 9-to-9 job. And therefore, I don't know how many people will be able to take recourse to these things.
All right, well, let's kickstart the show, right? We have lots going on in the next 2.5 hours, so let's not waste any time. Here's what our wise experts have to say as we head into trade this morning. The best of the brightest of minds, Ridhim Desai of Morgan Stanley, highlights a key debate in the market, which is whether the levy of long-term capital gains tax and the recent market correction acts as a precursor to persistent equity mutual fund outflows. He feels this is unlikely. Based on their calculations, Ridhim says the margin of safety, which is the amount the market can fall before portfolios report losses, is over 20%. Accelerating flows along with rising systematic investments in a rising market has naturally reduced the margin of safety as investors have bought more at higher levels. Having said that, Ridhim adds that negative trailing returns do increase the number of months of outflows in the subsequent year.
Okay, that's a warning. Here's more. Surendra Goyal of Citi says they met around 30 fixed income and equity investors in Singapore and Hong Kong last week, and the focus was more to understand the ramifications of the bank fraud, including further recapitalization possibilities, hurdles in the insolvency process, GST collection trends, and risks of fiscal slippage and political implications of the recent electoral trends. He says they discussed the various ways in which the government might try to stimulate the rural economy before the elections to prop up sentiment. Surendra Goyal says valuation concerns remain despite their India overweight positions, and on top of it, there is a risk of incremental fund flow towards China as its relative attractiveness improves. He says they also heard some concerns around India's ability to maintain a sustained growth if protectionist tendencies start dominating global trade. So that's a bunch of concerns.
Oh yes, a bunch of concerns. And you know what, it's a big move that we saw on the rupee as well. It's a 4-month low against the dollar that the rupee closed at yesterday, 65.18, a level that we saw last in November of 2017. So let's get that rate up for you. Bhaskar Panda of HDFC Bank says the dollar index is consolidating around the 89-85 levels ahead of the Fed meeting and a tariff war. He says the dollar INR pair is consolidating around the 65 pivot, and he expects a little higher range between 65.10 to 65.30 for the day.
And on the 10-year benchmark bond yield, Bhaskar Panda says it has started looking up after touching lows recently. He expects a range play within 7.58 to 7.65 for the day.
Okay, big decline in US market and you know, a lot of talk about what was happening with Facebook. Here's Nigel with the worldview.
Well, the US markets, they ended in the red in yesterday's trading session, and Nasdaq was the big underperformer. That ended with a cut of around 2% odd. Well, in yesterday's trading session, when the markets are lower, the CBOE volatility index, that took off. That was up close to around 20% odd. For the Dow, well, the biggest drag yesterday was Caterpillar. That stock was under some pressure. It ended with a cut of around 3%, and that was the biggest drag on the Dow. But the big talking point last night was Facebook. Now, that one was under pressure on the back of reports that suggested that political analytics company, that's Cambridge Analytica, they had access to nearly 50 million profiles out there. And on the back of that, Facebook was down nearly around 6%. And what it did was the other FANG stocks, so to call it, we had Alphabet as well as Apple, both those two stocks as well did come in for some selling pressure. Well, market participants, they are factoring in a Fed rate hike. That's likely to come about tomorrow. But shifting focus to the European markets, even though there we did see red. Now, there's heightened fears that, in fact, this trade war could continue, and on the back of that, all those three indices did end in the red. Remember, basic resources, they have been under some pressure, and that's precisely what happened. Stocks like Glencore as well as BHP Billiton, they ended with cuts of around 3 to around 3.5% in trade yesterday. In addition to that, you had technology as well as oil and gas stocks. They did come in for some selling pressure. Shifting focus to the Asian markets then, the Nikkei has got concerns of its own actually, because Shinzo Abe has been, accused of favoritism as well as various land deals. So that's what's plaguing them as well. But Asian markets, they are in the red. So that would mean the SGX Nifty is indicating a cut of around 20 to around 25 points just to kickstart trade. Back to you.
Okay, thank you very much, Nigel, for giving us that picture. SGX Nifty indicating a red start. Let's put these things into perspective. Yesterday, the markets, at least the global markets, have fallen without any major fresh trigger coming in, at least. Ken Peng, the Asia-Pacific investment strategist at Citi Private Bank, joins us on the phone line from Hong Kong. Thank you very much, Ken, for joining us in what may be an important morning, a busy morning for you as well. What explains this fall? I mean, it's now gone on and on. Is it still the trade war concerns?
Well, I think we have several things happening at the same time. You guys just talked about the tech issue. I think every time when you have potential increase in regulation on a previously lightly regulated market such as social media, you tend to have more concerns about whether the revenue models that these companies have will be sustainable. So I think this probably takes time to digest. And of course, trade is escalating a bit more now that the U.S. has shown that it's targeting China more specifically, and in a very broad basis to try to attack China's trade practices. I think that raises the risk of retaliation from China, particularly now that the National People's Congress just finished, and the leadership can kind of focus. I mean, the new people got their new jobs, so they can focus on things such as trade. So these two things will continue to be a source of worry. And of course, we have not figured out, well, interest rates also are still on investors' mind with this rise in LIBOR and basically higher, more expensive funding costs. So all these things combined together, I think it will take the market a little while to figure out exactly how to deal with it.
Ken, hi, good morning. We're going to talk about global markets in greater detail, but before that, also wanted your thoughts quickly on India, because there's been large-scale selling here. We've underperformed most of the global markets this year. Do you think it's domestic problems that are taking us down, and would that underperformance continue?
Look, I think India, the situation is a little tricky because it has not really delivered on very lofty earnings expectations, right? So in terms of the gap between actual earnings last year and expected earnings at the beginning of 2017, the miss was the largest in India compared to the rest of the region, and the revisions are still kind of negative at the start of this year. So I think the earnings outlook is a bit dicier for India, particularly now you combine with the current account and fiscal account worries. But I think these should be temporary issues, because I do still expect the significant reforms put in place over this past couple of years will bear fruit and pay dividends in the longer run.
Okay, so Ken, to come back to global markets, are you seeing, after all, the Facebook issue is only social media stocks, not so many of them in the Asian, indices and Asian markets. How much lower can Asian markets, especially Indian markets, go because of these global worries, say, of interest rate and trade?
Well, that's a billion-dollar question. So I think the trade situation, my view, is that the purpose of the Trump administration is to just get a better deal for the U.S. And I think generally speaking, like things like removing or reducing tariffs and opening up financial markets is consistent with China's own development goals. So there is common room for negotiation here. So I don't think this would necessarily devolve into a trade war. If that is the case, then we would still focus on earnings growth. We'll be getting a lot of earnings coming, in the next month or so, and I think we'll still be focusing on that, and we'll still expect that the earnings growth is relatively resilient, particularly in the stronger, sustainable consumption areas. So I think the market should be relatively resilient, so long as the earnings picture remains solid.
All right, so the market should be resilient. A lot of people are expecting a rate hike at the FOMC policy, but do you think that Jerome Powell's policy making could be very different from his predecessor?
Well, I think we're just in a very different macro backdrop now. I think the Fed is worried about falling behind the curve too much. And I think more and more of the FOMC believe that inflation will eventually catch up. So I think it's just a different macro backdrop, different position in the business cycle. So I think the likelihood of upward revision to the FOMC's own rate forecast is very likely.
And if that happens, will markets react negatively? For instance, if the dot chart were to indicate 4 hikes this year.
I think it's probably too early to do that right now. I don't think that's going to happen on Thursday, but I think that is probably the direction. You start to see a shift, right? The number of dots above 3 is probably going to increase, but will the median go right straight to 4 hikes? I don't think it'll happen this week.
Okay, Ken, thanks. We'll touch base with you once again post the FOMC policy. That's the word coming in. They say that there is still some resilience that global markets have towards issues like trade wars and the rate hikes. We'll take a short break on that note. We'll focus on our markets where there's been a lot of pressure. CNBC TV18's top 10 list of stocks to watch when we return. Stay with us. Welcome back. Asian stocks are slumping, taking the cue from Wall Street, of course. So, markets like Hong Kong down almost 200 points, Nikkei down more than 200 points. Oh, in fact, Hong Kong is now inching towards almost a 300-point cut. So, let's see how we go. Today, our research team is here to give you the list of stocks that you can prepare yourself with as we head into trade this morning. So, let's welcome them. Anuj, what are you looking at?
So, could be a bad day for midcap, Sonia. In fact, yesterday we saw indication of that 1:6 advanced decline. Arvind, for example, classical 20 DMA halt on the way up. Huge delivery selling yesterday, trading below the 200-day moving average. From the highs of 480, the stock has seen a big decline. But the market could see comfort in FMCG. Yesterday, for example, I pointed out about HUL. I think stocks like Marico, for example, even in a weak market, that stock ended in green and saw doubling of delivery volumes. So perhaps the defensive flavor continues with FMCG, and that could be the space to watch.
Okay. Well, I think one important stock we should watch out for is GSPL because it seems to be giving its promoter GSPC some relief. Sonal, tell us the transaction.
Well, that's right, Lara. GSPL will be buying 28.4% stake in Gujarat Gas from its parent GSPC in an all-cash deal. Well, the price of the deal is not known, but based on yesterday's closing price, the deal will be valued at around 3,200 crore rupees. And I spoke to a couple of analysts. They are saying that this is majorly done to bail out the parent. Remember, the parent has a huge debt, and that is why the transaction is done. This will lead to an increase in the stake in Gujarat Gas by GSPL to 54%, making it a subsidiary. But the key question remains is how will GSPL really fund this whole deal, because remember, currently it's a net cash company, and to fund this deal, they might have to take some debt, and it will make them a net debt company. And some of the analysts are saying that this will be EPS decretive, so this is negative for GSPL, and expect that stock to be in red today.
Oh yes, GSPC of course is the unlisted parent.
Which gets relief.
Exactly. GSPL and Gujarat Gas are both listed. GSPL, of course, there could be some problem. I don't know if the market knew that, a bit of that, because the stock has of course been falling, but it would be in the red for sure.
And there is a Nomura note saying it is
yes.
EPS decretive.
Yes. What about the aviation stocks, Sonia?
Well, the growth has been very good. Domestic air passenger traffic has grown the fastest in 13 months. We haven't seen a 24% growth in a very long time. So, let's just get that chart up for you. Over the last many months, you've seen on an average about a 16 to 17% growth. And suddenly in the month of February, it surged to about 24.1%. So I expect at least these stocks to be a bit resilient compared to the fall we've seen in the market. In terms of individual stocks, Interglobe Aviation's passenger traffic growth has been very, very strong, 25% plus. In fact, they've slightly increased their market share as well. It's gone to almost about 40-odd%, 39.9%. And SpiceJet as well, the passenger traffic growth has been healthy at 17.7%. So I expect these stocks to be in the green today.
Okay. Well, there's some green spot at least. Ekta, why are you watching Dr. Reddy's?
The 5 observations which were issued to the company's Medak CTO Unit 3, which was inspected by the US FDA, in the first week of March, has now become public. So basically, those 5 observations indicate that yes, there is some work which is needed to be done by Dr. Reddy's for that particular unit and remediation, but it doesn't point to something which is not solvable. So, however, I expect the stock to be in the red, because obviously there is always some concern when there are observations to a particular unit. But the positive is that this particular unit is not that much in terms of a percentage of sales for Dr. Reddy's. But nonetheless, it would obviously be a sentiment negative.
Okay, thanks a lot for that. Sentiment negative for Dr. Reddy's. But what about other stocks in the news? Mangalam joins in to give us a list of that. Mangalam, over to you.
It's only I'm watching out for 2 stocks. The first one is Granules, may hold up in an otherwise weak market, given that it's got an approval from the US FDA for a pharmaceutical drug called Glucophage XR, which is used to cure type 2 diabetes. Metformin is the generic name. Another stock I'm watching out for is Narayana Hrudayalaya. They've commissioned a new hospital, super specialty hospital in Gurugram, so more capacity added to Narayana Hrudayalaya. And then, of course, we'll watch out for Granules.
Okay. Nigel, you too have some stocks on your radar.
Well, that's right, Lata. A few stocks that we're looking at. Firstly, we're looking at Axis Bank. Remember, DOT had ordered, no new bank guarantee to be accepted from Axis Bank. Now, Axis Bank, they've clarified. They're saying that, in fact, the TD SAT ruling had prohibited them from making any payments on the invoked bank guarantee. Once, in fact, the stay is lifted, they'll go ahead and they'll honor any kind of payment. So there is clarity coming out of there. You can expect some mild green over there. The other stock we're looking at is a rather small cap company. We're looking at Elpro International. Now, forever we know that, in fact, the company holds 12.75% in PNB MetLife. Now, last evening, they've come out with the disclosure. They're saying they're looking to sell 1.25% for around 125 crores. Then they'll be left with more than 11% that will be valued at more than 1,000 crores. The current market cap is only around 650 crores. So you can expect the stock to open up in the green in today's trade. And finally, Take Solutions. We're looking at that stock because they've said they're looking at issuing shares to its promoters on March 22nd. So keep an eye on that stock. That as well could see a shade of green. Back to you all.
Okay, thanks a lot for that, Nigel. Here's a quick recap now of our top stocks to watch. Expected to gain today are names like Marico, Jet Airways, Interglobe Aviation, SpiceJet. You have Gujarat Gas, Axis Bank, Elpro International, Take Solutions, Granules and Narayana Hrudayalaya. While stocks expected to be under pressure today, Arvind, GSPL and Dr. Reddy's Laboratories. But Ultratech has re-entered the race for Binani Cement and has in fact proposed to acquire the stressed company. They've lent huge comfort by saying that they will provide over 7,200 crore rupees to help Binani pay off its lenders. We spoke to Samir Kaji, the senior advisor at Binani Industries earlier, and he says that they are still in the process of working out the final arrangement, after which the ownership will move to Ultratech. Listen in.
We feel the value has been underplayed. Information sharing by the RP, transparency, which we felt was lacking. And we are not certain what are the main contents of the bid. We are in the process of working out the arrangement, and the ultimate ownership of the asset will then move to Ultratech. Being an evolving process, there is no precedent as of now. But if you are meeting all your liabilities, I feel this could become a precedent. We feel that NCLT has broad powers and they could withdraw the reference made under Section 65 since we plan to meet all legitimate dues of Binani Cement. And we feel it's a distinct possibility.
All right, that's the word coming in from Binani. This is going to become a knotty issue, but the market is going to remain the big focus for our discussions this morning. Soon after market opening, we are going to have Abhay Lejawala of Deutsche Equities joining in to chat about the fundamentals. And for the technicals of the trade are lined up right after with Lawrence Belanco of CLSA.
And not just that, we also have some important corporate guests as well. Bhaskar Bhatt of Titan will join in at 9:45 a.m. to talk about the latest in the sector. Incidentally, that is one of Abhay Lejawala's top picks as well, so we'll speak with him. Dabur Sunil Duggal will join in at 10:15 to talk about the pickup in demand. Remember, Anuj was also talking about how, FMCG is one space that could be defensive. So let's find out more on what's happening on the ground. We'll take a quick break on that note, but our technical experts, Ashwini Gujral, Sudarshan Sukhani, Mitesh